We start today's market talk. Sentiment may be stirred but not shaken. This is how James Bond may say it because if you see last week, Nifty recorded a new all time high on 20th of December, and just as people were relaxing, then the selling came out of nowhere and shook the confidence. The reason was a steep fall in around 2 hours or so. And within those 2 3 hours, market erased a whole lot of gains. But on the next 2 days, market has pulled back around 61% of the decline, and now we wait for further cues. But at higher levels, we will see supply coming in till this month's expiry because those people who are having long positions will book out at each rise. Talking about the market setup as I see it, risk today is that the Fed validates the market loosening with sizable rate cuts next year, but then is forced to reverse course later. So the point is that the Fed may prematurely pursue big and early cuts in the policy interest rates to please the markets and go with the narrative. But as we see it, inflation may still not subside and may come back, and then they may be required to change the course of their policy. Also, there is a policy divergence between Fed and Bank of England and ECB. Hence, as Fed is talking about doing rate cuts, they are not talking about doing rate cuts, and because of that, the dollar may weaken, which will benefit the emerging markets and their equities. At this point, all the positives are built into stock prices and valuations. Financial markets have rewarded investors handsomely, and now these people are hungry for more, willing to take big risks. We know that what Fed will do, what will happen in general elections in India, our growth forecasts, and interest rate forecasts. Other thing which we know is SIPs will continue and may increase. So what happens is if all positives are known, they are already factored in the price. The fear of missing out, that is FOMO, will add zinc to the markets. But I think 2024 we will peak out and then soften progressively as every positive news narrative will get priced in. Year-end rush of IPOs. A lot of small cap IPOs have come up in the last week plus. Subscription numbers have been helped by investor interest and mutual funds which are flushed with uh, liquidity. Remain positive on Varun Beverages after this South African acquisition. Firstly, Varun Beverages is now moving into under-penetrated markets in India and may achieve higher growth rates in international geographies, which would drive their earning growth. It remains insulated from broad slowdown faced by other FMCG majors due to consumption slowdown. It acquired 100% stake in Beverage Company Limited South Africa, which is licensed to distribute Pepsi products in South Africa, Lesotho, and Eswatini. Sting and Nimbus will add to growth. Expect 40% growth in revenues due to higher penetration in South and Western India. If we see the expected EPS for FY25, it is 23.24, and giving it a PE of 50 to 60, we may see a target of 1250 to 1500 in a year plus. The EBITDA is also improving from 18% now, it is likely to improve to 23%. Wealth management firms are in a sweet spot due to buoyant capital markets. Now, some of the wealth
wealth management companies which are good are 61 WAM, which was actually earlier IFL Securities, Nuvama, Anand Rathi, and Prudent. Prudent Corporate Advisory basically is a distributor of mutual funds. So 82% of the revenues are coming from mutual funds. They also distribute other financial products ranging from insurance to fixed deposits. Since as a mutual fund distributor, they are 95% AUM is equity oriented. It earns higher commission as compared to others like Anand Rathi, where they have got mostly they are giving is the market linked debentures. Now, post this sharp rally in IT, investors should look for validation of the optimism from the commentary of the Indian IT service companies. We've seen a sharp rally since October. Accenture's earnings were in line, so don't expect any change in guidance from the Indian IT majors. In my opinion, people should book gains ahead of the earnings. In the last 2 months or so, Cyient, KPIT, Coforge, and Persistent were the best performers. Guidance of Accenture of 2.5% revenue growth was tepid, though generative AI will be the big opportunity, but discretionary spendings have slowed down. So that is the challenge. Now, talking about Inox Wind on somebody's request, the point here was that it was uh, the basic issue is that wind energy sector in India has become a duopoly. There are only two players, Suzlon and Inox Wind, because balance have lost out. The reason is they're running huge losses is because till 2017 the wind energy was in great demand in India. Post that the government changed the policy, so their profits declined, and then the focus shifted from wind energy to solar energy. Now the government has changed policy and started giving more incentives and all that, so it is now coming up. And what Inox Wind did was, say around this November period, where the it took off from the this point of around 210 odd, was that uh, they paid down their debt. So what they did was uh, the promoters had put approximately 1840 crores through preference shares and sale of certain assets into the company. Now they had a net debt of around 2715, that is 2715 crores of debt as of March 24th. So they have reduced their debt to 434 crore by March uh, by next year now. So that is the reason why the stock has got re-rated. Plus they are getting a lot of contracts. What they are expected to do is they are expected to do 600 megawatt and 850 megawatts in FY25 and FY26. And once the debt is monetized, the earnings will improve from losses. Current order book is around 1.3 gigawatt, which is decent. So if you see what people are mostly the contracts they are getting are from the PSUs like NTPC etc. who are or the SJVN, NHPC who have also been told to do the power projects or OMCs also through this wind energy. Uh, so what people are looking at from the PSU stuff is that they are looking for people who can provide full stack services. That is, who can do supply, installation, and maintenance of turbines. Now they have a subsidiary called Inox Green, which does the operation and maintenance. So they supply all these things. Hence, keeping that in mind, in my view, if you see the EPS of FY25 around 30 odd and giving it a PE of around 25 to 30, 350 to 400 odd is a fair value. So it's already reached its fair value because of the momentum in the market. It is now slightly uh, expensive. So wait for a correction to get into this stock. Now, coming to certain technical aspects, this is US 10-year yield, a daily chart. So, if you see, the 10-year yield is now dipping. It has come below to 3.9, and now it is remaining at around this place now. But it will dip once there is a clear signal of a rate cut by 25 basis points. So then it will start going down, and it will take all the yields down all over the world with it. So till the time it remains in these levels and it is not spiking, it is positive for equities. Crude, again, I had given the target is around 70. It should go there. It had a spike last week because of the problems in the Red Sea and all that. But it is not expected to go up because the demand is expected to be tepid and there is a lot of supply right now. Dollar index, because of the possibility of rate cuts and differential, as I brought out between Europe and that is Bank of England also. The dollar is dipping, and it is expected to, I think, test its 200 EMA, which is at around 100.271. So that should get tested. So that is good for emerging market and equities. Gold, it again went to test that 2070 level. So this is the level at which it mostly faces resistance, and this is where it has made this kind of a top 3-4 times. So let's see what happens here. Dow has had 8 weeks of continuous green candles, and it has broken through its declining trend line, and it took support from the rising trend line, long-term rising trend line. Now, this is expected to do better. So, and if the US markets do better, it, the positivity goes into the rest of the world markets. Indian 10-year yield is declining as the rates are expected to decline. So, this is positive. Now, coming to Nifty. Uh, Nifty, if you see, this is a weekly chart. So after 7 weeks, it had a red candle, and it corrected last week. It went down to below 21,000 levels and then bounced from there. And let's see what happens from here. Uh, but it will be tough for Nifty to continue higher as due to the holiday weekend. Now, there may not be any market moving events which are now expected till now January, where there would be those results will start coming in. So, uh, my suggestion would be that wherever you find there are stocks and momentum, wait for them to be driven to their nearest supports, that is 20 or 50 EMAs, and then buy the pullback. So, no point in chasing the ones which are there because they will all correct to their moving averages. Now, if you see the daily chart, on the daily chart on 20th, after the uh, all-time high of 21,600 was made, the market had a huge dip, and then it went and tested that gap which was there, which it formed pre after that uh, the Fed rally, the rally due to the Fed move, but it bounced back from there, and it has come to that 61.8% retracement zone. So we'll see from here what happens. Uh, Now, if you see the hourly chart, so this was the high it made. From there, it went down to this 29.77. Then it has bounced to that 61.8% retracement level, and it is above the that at these levels now. So it can go anywhere, but this 20,900 odd zone would be 950 or that level would be critical because there is it has taken support. So uh, I personally feel that this low of in this 20,900 950 may be retested again uh, this week again as per the requirement. Now, Reliance, this is a daily chart. Reliance is looking strong, and this was one of the reasons why the market was strong. Actually, didn't dip much, and it bounced back and led the market up. It is comfortably trading above the 20-50 EMA. So continue to remain invested. There is no panic right now. The other stock which was strong is Larsen. It took support at its 20 EMA and then it has bounced back from there. And now it is likely to head higher and lead the Nifty higher. Nifty Bank, this is a weekly chart. It made an all-time high, went above that, and then from around 48,000. So last week it corrected from there and at a decent red candle. So this level of 47,000, which it tested this week, should be crucial level to watch, because below this, then it will again become weak. And this is the daily chart. So it has broken out above the last resistances, and now we'll have to see, because the the 20 EMA is coming around 46,700. So this zone will become important, and we'll have to see whether it is able to remain above that. But in the present environment, in the immediate future, in short term, it is looking difficult for the Bank Nifty to go above the level of 48,000. HDFC Bank, uh, broken out, continues to be the leader in this pullback, and continues to be strong. And it is the one which is keeping the markets up. So let's see from here what happens. Uh, till the time it is trading above this 1623 levels, uh, it is in it's in a bull market now. So it should do well, because here if you see, the 20 EMA has crossed over the 50 EMA. So now the trend has become positive now. So it should make higher highs and higher lows now. ICICI Bank, this was disappointing. It made an all-time high of around 1050 odd, and then corrected and has come back to its 20 EMA below 1000. So this 1000 odd level, or this level of 995 odd, would be critical, because this is the 20 EMA, and if it is able to take out, go above, then it should be positive. Otherwise it will become weak and go down below. And this is the one problem which is there, between one of them is not able to move, between HDFC Bank and ICICI Bank. PSU banks, again, is a weekly chart. The rally halted and it came down, and so it has also run up a lot. So it has paused to take a breath. But till the time it is above 20 EMA, every dip becomes a buying opportunity in all PSU banks. This is SBI. It went and made a new high. It is broken out, and the 20 EMA is again, like HDFC Bank has crossed above the 50 EMA. So it is trending upward. But now last 3 days it has had weak sessions. So let's see from here where it goes. But till the time it is trading above these supports, this is positive. PSE index, this is a daily chart. It had a big red candle on 20th. Then it is, seems to be taking off from there. But this is one of the strongest sector, and generally it takes support at its 20/50 EMA. If you see, this is a daily chart. So from March, if you see, it has always taken support and has gone up. And if you see, in the March, levels were around 4400. So now it has reached 7600. That is 3200 points rally. That is around 65 to 70% rally in this index. So it has to take a breath, pause to take a breath now. It can't just keep going this thing, and it will be dependent on policy actions. This is BEL. This was a strong stock last week. It had a fall, but after some contract wins, it was gone up to new high of 174 odd levels. So here remain invested. So positive stock. The other one was BDL, made a dip to around 900 odd on 26th October, and then has constantly gone up. And with the export of these Akash missiles, this should do very well, as the things will remain positive for defense sector. IT index, it had a kind of a flat week. It corrected, but it has bounced back. So it is right now waiting for the results. So if the results are tepid, then it should come back and test the upper trend line. But please be careful. My recommendation is book profits because services are not expected to be having a very positive outlook for future or near future. Infosys, it's broken above the uh, last week. It broke above the declining trend line, so it was heading higher, but now it has been stopped, and people are waiting and watching and all that. But again, the stock which was strong was Coforge. There's a weekly chart. It has broken out to all-time high. So, but again, it went back, but it recovered very quickly. So, this is a stock which is in positive area right now. So, it should continue to do well because their guidance is much better than Infosys oblique TCS. The Midcap index, a daily chart. Uh, it came down, tested the 20 EMA. Now it is then it went down and then recovered from there. So again, it has been positive and it has been trending upwards. So any levels in the mid cap indexes and mid cap stocks, every dip is a buying opportunity. Similar chart is with the small cap index also. So worst case, it may test the 50 EMA, but it will bounce back from there. So it actually went to the 20 EMA on 20th December and then has bounced back from there. So let's see if it is able to recover. But this was a very big red candle. So this is a concern. Now the stocks I'll cover today. The first one is Siemens. Uh, The order inflow prospects remain strong from transmission, railways, data centers, industrial automation. Opportunities are emerging from new areas such as semiconductors, batteries, and electric vehicles. A potential demerger and listing of Siemens India energy segment should open avenues for value unlocking over the next 2 to 3 years. This is the one reason which has given the recent spike to the stock. Overall order inflows for the year jumped 139% year on year, including a large locomotive order worth 26,000 odd crores from Government of India. The order book for the company is at the end of FY23 is at 45,000 odd crores, which is quite good. And the company is optimistic about growth as prospects from increasing spending by government on infrastructure, rail, road, energy. Uh, the basic issue is expect PLI-led spending of roughly 4 lakh crore over the next 4 to 5 years, which they would be directly or indirectly involved. Data center market opportunity of 40 to 50,000 crore over the next 2 to 3 years. Rail segment opportunity of rupees 10 to 11 lakh crore and transmission-led spending of 2.4 lakh crore by FY30. So what has basically happened is that the total addressable market for Siemens has expanded across all segments. Hence, they can bid for more contracts because the money available is more. They are doing a capex of 416 crore for capacity addition for power transformers and vacuum interrupters. They also had a subsidiary which was for wind energy, but I think that is also they will close down that or sell it to somebody else because that has not really done anything. The strong results have been due to strong execution from mobility and digital industry segments. This demerger will take 2 to 3 years, so which will unlock value. Uh, FY25, if you see EPS of roughly 77, 78, and you can give it a PE of around 55, 60, so you can give a target of 4,500 to 4,800 next year. Uh, they are making India's first 9,000 horsepower electric locomotive for Indian Railways, and they have been given orders for 1,200 such locomotives over the next 11 years. And in case their supplies are good or something, they may be repeat orders also because there is a major transformation which is taking in railways. This is their uh, revenues. To see net sales are improving and they're expected to improve 15 odd percent, 15 to 16% over the next 2 to 3 years. The gross margins are expected to be in the 30% category. EBITDA margins are around 12 to 13%, but are improving. And PAT, profit after tax, is expected to improve around 17 to 18% as the margins are improving. So it's positive with a clear-cut order inflow. So if you see here, they have a, as I brought out, they have a order book of roughly around 45,000 crore, and they are doing roughly 22, expected to do, this is in millions, so 22,000 crores revenue next year, no, this current year. So that means they have an order book visibility of at least 2 years. So there should not be any major dip. Now, as I spoke about financials and valuations, so if you are seeing FY25 78 or this thing EPS, so it can get around 4,500 to 4,800 levels very quickly, and in case there is a spike in manufacturing and all that, because they are the ones who are making real assets. So this P should be around 50 odd for FY25, but they have been trading at much higher P throughout, so that should be not be a problem. And ROC, ROE are expected to improve. Debt is negative, so they are positive cash flow companies. So balance sheet and financials are okay. So this is the chart. Now you see they had a declining trend line which they have broken out, and they support at this declining trend line or the 20 EMA, which is at around 3852. So this should be the level to get into this stock at 20 EMA for a long term horizon. So you can get exactly around 1,000 rupees in next, from here, if you get it at this price in next 1 or 2 years from here. But this is a portfolio stock. Now the other stock is JK Lakshmi Cement. Why I have covered this stock today is because this will help people understand how to value the cement companies. Uh, they are doing a capacity expansion as its subsidiary, Udaipur Cement Works Limited, of 2.5 metric ton per annum. Grinding unit is progressing well and is expected to commercialize in Q1 FY25. They are setting up a grinding unit in Surat of 1.35 MTPA at a capital cost of 220 crore. They have guided for a double-digit volume growth in FY24 and expect a volume growth of 7 to 8% over next 3 4 years, driven by higher demand and higher cement consumption. Now here comes the most critical part. Capacity expansion and many strategic initiatives are expected to improve the company's EBITDA per ton to rupees 900 to 970 in over next 2 3 years from the current level of 700 per ton, and this will actually lead to greater profitability. They are focusing on increasing the sale of value-added products like ready-mix concrete, autoclaved aerated concrete, and wall putty by setting up additional plants. So if you see here, this is in crores. Kindly switch off your volumes, please. Net sales are expected to improve. Profit is also improving. EPS is expected to be going up progressively. The PE is coming down. EV, this I will cover subsequently. EV EBITDA, this is how to value these companies. EV is enterprise value to EBITDA. Enterprise value is found by adding market cap plus the debt and subtracting the cash from there. This thing is basically used for mergers and acquisitions. So EV EBITDA, anything EV EBITDA below 10 is healthy, and basically EV EBITDA is used for comparing companies within the same industry. Now, why am I covering this? Is because there is a talk of a lot of acquisitions in cement sector. Hence, you must understand where the value is. Because of the current growth of real estate and infrastructure, the cement demand is expected to remain robust. So it can easily give 10% odd revenue growth over next 2 to 3 years. Now, these are the various ratios. Gross margins are improving. EBITDA margins are also improving. PAT margins are improving. Depreciation to gross block is around 5%. So sales growth are expected to be around 10 odd percent. Volume growth again, it's around 8-9%. EBITDA growth is now going to be there. There was no growth in FY23. So there is a turnaround. Sales to gross block. Gross block is sum total of all assets of the company valued at cost of acquisition. So if the sales are higher than the value of all assets at cost of acquisition, that means they are actually able to turn over their assets better. And net block is gross block minus depreciation. So that is still better. So the PE is reasonable. Price to book value again is reasonable. EV to EBITDA, if FY25 is below 10, that is good. So though all the ratios are decent. Now, if you compare the values of all the companies which are in the cement sector, so we will see the EV EBITDA because that's how you value them. Now, current EV EBITDA Ultratech is around 25 and JK Lakshmi is around 13. So you can see Ultratech is twice as expensive as compared to JK Lakshmi, and you can see relatively their price values and EV EBITDA. So, and as the earnings are supposed to improve, that is, EBITDA is supposed to improve if the denominator increases. So, this EV EBITDA ratio will fall down. So, they are expected to do better, and if they are expected to reach single digit, so it will get re-rated. Now, this is the cement player wise EBITDA per ton. This is critical. So, if you see Q2 FY24, as I told them that they're planning, they are hoping to reach around 900 odd this thing. This is the present EBITDA per ton of various companies. So, if you see Star Cement at 1100, Shree Cement at 1000 plus, JK Cement, Ambuja Cement, and here JK Lakshmi comes at around 750. So if it improves by 150 to 200 odd rupees, so that will add to the margins and performance of the companies. So this is the critical parameter to see while valuing these companies and all this, because what is their EBITDA per ton will determine their valuations or how they are given valuation in EV per EBITDA. So that is why if you see this, because of higher EBITDA per ton, this Ultratech Cement and Shree Cement were at higher EV per EBITDA, and plus they have got larger size. This is a chart of JK Lakshmi Cement. It is now coming down. So if it comes around 800 levels, there should be a decent level to get into this stock for a long term. It has come below the 20 EMA on 20th, then it has bounced back. So let's see. But this is the stock to hold for a long time because outlook is good for this.
The next stock which we're going to cover is Swan Energy Limited. It has presence in energy, textiles, and real estate. It acquired Reliance Naval and Energy Limited through NCLT, and they will become a major player in defense shipyard business. HWEL's takeover of Reliance Energy and Reliance Naval and Engineering Limited via its 2133 crore NCLT bid marks its foray into the business of ship repair, building, and braking. Swan LNG Private Limited has successfully onboarded a 5 TPA FSRU with 4.5 TPA of capacity already tied up. It is in talks with potential customers for tying up a further 5 TPA, which should double its capacity even as it proposes to order another storage unit FSU. FSRU is floating storage regasification unit. FSRU stores and regasifies the LNG to deliver high pressure natural gas to shore. Currently, their FSRU is leased to a Turkish company and they are earning revenue from that. They already have contract with GSPC, ONGC, BPCL and IOC. So if they have a long-term contract with OMCs before start of the project, it helps in revenue visibility. It is investing 1800 crore to set up 150 TPA PVC plant and 360 TPA PMB capacity at Dighi Port. It is also building a throughput terminal, 1.4 MMTPA and bottling unit 60,000 MTPA at Dighi to cater to ever increasing demand of LPG. This has been possible because of acquisition of Veritas India, which has helped it to set up their PVC, that is polyvinyl chloride, and PMB, that is polymer modified bitumen plants, and liquefied petroleum gas bottling plant and gas storage capacity at Dighi Port. The existing commercial properties in Hyderabad and Bangalore are generating consistent and steady cash flow, while the 1.9 lakh square feet housing project is expected to be completely monetized in FY24 itself. The steady cash flow generating textile business is expected to benefit favorably from the fast improving fortunes of the textile industry, which is this is the textile is their basically the original business they had. They are expected to complete the first phase of port infra in Zafrabad by March 24, and then they will start that floating LNG terminal from April 24. Reliance Naval will also first monetize the semi-finished ships which it has inherited of around 2000 crore. The shipyard is in Pipavav, Gujarat. At Verasco Free Zone establishment, which is a subsidiary of Veritas, they have set up a complete integrated chemical store and storage and handling terminal at Hamria Free Zone in UAE, Sharjah. They are planning to build an integrated industrial complex at Dighi Port. The PVC is required for infrastructure projects and PMB for roads and heavy roofing solutions. They have got 125% capex subsidy in addition to state GST reversal over 9 years from the Maharashtra government, ensuring visibility of ROC, while demand supply mismatch in these two products should ensure steady cash flows. The structure of Swan Energy is the original business was textile, which they own 100%. Then Hazel Infra Limited, through which they own Reliance Naval and Engineering Limited, which is into shipbuilding, repairing, and heavy fabrication facility at Pipavav Port. They have another subsidiary now, which they acquired, Veritas India Limited, which is into chemical trading and warehousing and is creating upcoming capacity of PVC, PMB, and LPG throughput and bottling at Dighi Port. They have Swan LNG Limited, which is into LNG, FSRU, and LPG throughput at Zafrabad Port. They have Triumph Offshore Private Limited, which is through which they lease the FSRU to Swan LNG, and Cardinal Energy and Infrastructure Limited, 100% owned subsidiary, which owns the commercial properties in Hyderabad and Bangalore, and real estate projects in Bangalore. This is in Gujarat, the Zafrabad port. So if you see, it is around 317 kilometers from Ahmedabad, and it is in along with this the LNG and natural liquefied compressed natural gas lines are already created. So this should help the transmission of this gas to rest of the country and to the OMCs. There is a location of Dighi Port, which is south of Mumbai, and this is in a major industrial area in this area where other facilities are also coming up. The Veritas petrochemical project, which is coming up at Dighi Port, has two phases. First phase is 150,000 MTPA PVC manufacturing plant, 360,000 MTPA PMB plant, 6 into 2500 CBM mounted bullets for vinyl chloride monomer storage, and which is basically the raw material for PVC and other plant infrastructure. This phase 1 is supposed to be commencing by October 23 and is envisaged to be completed by September 26, with 1st October 26 as a scheduled commercial operation date. In phase 2, they would have 60,000 TPA LPG bottling plant with composite cylinders bottling, 26 into 2500 CBM storage mounted bullets for LPG which are propyl. This phase 2 implementation would be dependent on the successful operationalization of phase 1 and market conditions. See their financial data. FY22, FY23, they were just starting out weak, but FY24 they're likely to do around 5,000 odd crores of revenue, which is supposed to double every year to reach around 22,000 crore in FY26, with net profit reaching around 960 crore and EBITDA percentage at reaching decent levels of 20 to 16%. EPS is expected to reach around 36 odd, and ROE and ROC is also expected to improve, with PE going to go down. So this stock will become inexpensive at these valuations by FY26. This is the financial summary of Swan Energy. So if you see here, the textiles were the major part of the business over the years, with now Veritas providing the revenue visibility. Others are just coming up, but by FY26, if you see, the textile will be a minor component. The major part of the revenue will come from Veritas energy business, where they're establishing these LNG terminals, and Reliance Naval, the shipbuilding part. So which will be contributing, these three verticals, new verticals will be contributing to revenue of 22,000 odd crores with the EPS of 36, and at the rate at which they are growing, they should get a PE of around 30 to 40. So the stock should trade at around 1000 plus from here. So these are the ratios. So EPS at around 36. The solvency ratios are decent. There's no problem and improving. Return ratios are good. Working capital ratios are also under control. The valuation is becoming inexpensive over the years as the revenue and the profits grow and the margins improve. This is a revenue mix of Swan Energy. So if you see here, the composition of textiles is reducing and the composition of Veritas, the chemical part, LNG, LPG, and Reliance Naval will increase, and they would be forming the three major components of the revenues. This is the kind of a depiction of the LNG terminal which they will create. So the LNG ship will berth next in the area, and it will have FSRU and FSU, which will store and regasify the LNG to compress natural gas, which will then it will be sent to the shore and then to rest of the country through pipeline. This is the technical chart. So if you see here, it was in this level of around 200 start from March, April onwards. Then it went to around 230, 40 odd, and then from August it has taken off above the 220 EMA. And post November, it has had a vertical rise with higher volumes now, and now it is trading at around 500. So this is a stock to be accumulated on all dips closer to the moving averages. I have finished. We will take questions now.